Hello and welcome everyone to another Main SBDC webinar. We are gathering for part 4 of a 4-part series for financial projections with Main SBDC at CEI Business Advisor Rainer Large. My name is Kelsey Reardon, and like I've said before, you've probably gotten more than enough emails from me by now. And so you'll get one more after today's presentation, but that will come tomorrow. I won't be able to send that out this afternoon. So tomorrow you will receive the slides as well as a link to the recording and all of the information that's usually in those follow-up emails. So if you have any questions, feel free to respond to any of those emails at all. And if you have questions today, we'll keep using the chat. We are a small group, so Rainer seems to prefer if you just unmute yourself and ask a question. Otherwise, I think we're all set to get started, so I'll pass it over to Rainer.
Perfect. Thanks, Kelsey. Yeah, looking forward to diving in. We have a shorter class today. We're just going to focus on some of the effective uses, best practices, and how to continue to use this tool and not save it in a file somewhere and never look at it again. Like Kelsey mentioned, small group today. Happy with that. So feel free to take yourself off mute, blurt out your questions, whatever comes to mind, and we can go through it. Just a quick review. Last couple of weeks, we've talked about kind of the differences in the financial statements, why they're important, why it's structured the way it is. Talked about pulling information from QuickBooks, particularly your historical income statement, and then using that historic performance as well as kind of your critical thinking and analysis to look forward and project that forward over the next 12 months into 2022. So, just breaking down the income statement, it always comes back to this. This is your operating performance. This is how well you're utilizing your assets to generate revenue. So we look at that revenue breakdown as first, how much revenue are you making? How many sales or services are you providing? What percent of that goes out the door to pay for the cost of goods, which are those direct costs that we control and predict as a percent of revenue? And what is going out the door to cover your overhead cost, more fixed cost unrelated to revenue, but still necessary for operations? And then of that, what is left over? Right? What is that net income, the profit margin that you have to the bottom of your income statement that you then utilize to reinvest in your balance sheet, to buy new assets, to pay down liabilities, or to pay yourself, hopefully, as equity. So, as we use this model, change the model, try to focus our efforts in the coming year, it's really 3 goals, right? You want to maximize your sales, increase that green portion as much as possible. You want to control your direct costs, be more efficient, reduce that yellow as a percent of revenue, and then control your overhead. Not necessarily reduce your overhead. There are valuable ways to invest in additional overhead costs, but understanding what that is and recognizing if there are parts of that overhead that tend to trend upward year over year. Excuse me. So today we're going to look at the simple cash flow model. We'll walk through how to change it so that we can talk about reinvesting, making those changes, those active solutions to things that you want to see in the coming year, and how that plays out from a cash perspective. The first thing we're going to do is I'll walk through how to convert what we have now, which is an income statement projection, into a more or less simplified cash flow model. Right? So if you remember, the difference between those two is that an income statement talks about a specific point in time. So we have all of January activity, the sum of January. We have all of February activity, the sum of February. The income statement is operational, so it does not take into account principal payments, does not take into account taxes, and does not take into account capital reinvestment, new equipment purchases. So we'll add lines for that, and then we'll add a starting cash position, an ending cash position for each month, so that we'll be able to see the ebb and flow of cash and theoretically what your bank balance should be at the end of every month. And that's important, right? Because that allows us to see both the seasonality of the business as well as identify and make sure that we're ending the year, the next 12-month cycle, with more cash than we started, and that we're not dipping below zero at any point. I'm going to switch my share. Hold on. So what we have, where we kind of left off last time, and I've hidden some of the years so I can fit it on one paper or one tab here. So we've got our chart of accounts, which is this left side, right? This is our income statement, our revenue lines, our cost of goods lines, our overhead, and that leaves us with our net operating income. We put together our projections, which I break out into 3 different sections, kind of that logic behind it, the numerical value associated with that logic, and then a determination whether or not it's seasonal. And those 3 assumptions working together, we can use to project our 2022. So looking at this, I'm projecting to increase my sales at about the same rate, a little higher, going from 360, 374 to 406. My cost of goods as a percent of revenue, it actually went up a little bit over prior year. So I went from 56 to 55 to 56, back up to 56. And then my overhead costs, went from 98 to 101 to 104. So slightly up over prior year. But what that does is with the increased revenue and controlling my cost of goods as a percent of revenue, I'm putting more to the bottom line. So I went from 58 to 64 to 73. No dramatic changes, more or less in line. Now I want to add a couple columns or a couple rows. So I'm going to have a starting cash position, right, first and foremost. And my starting cash is actually going to be a manual entry. This is the cash that I'm going to have in my bank account as of January 1st, 12:01 a.m. Right, and we'll be able to. You'll have a better understanding of what this could be, but for the sake of putting something in there, I'm going to say I'm sitting on $25,000 at year end. It's been a decent year. I have my net operating income from prior year at 64. Paid some taxes, paid myself a distribution. This is what I have left. Then I want to back out taxes. This might be just an easy conversation you have with your accountant to figure out your tax situation and what you pay in taxes. But for my little business here, I'm a LLC or a sole proprietor, solely owned. It's just me. I file taxes by using a Schedule C on my taxes, and it's about 15.3% self-employment tax and then 10 to 15% state and federal tax. So for me, I'm going to use a 30% tax margin assumption. And like I said, your accountant should be able to tell you pretty easily what your tax margin is on income taxes for your Schedule C or for your business. And what I do is I'm going to pay this quarterly, right? Pay my taxes quarterly based on my projected year-end performance. So 30%, excuse me, 30% of 73,000 is what I'm going to end up paying for the year, but I'm going to divide that by 4 because it's quarterly, right? I'm going to pay that every 3 months, which gives me just a rough estimate of kind of what I need to be paying quarterly to cover my year-end tax burden. So backing that out, I want to back out principal payments. And the easiest way for me to do that is I'm going to add back interest, which I think I do account for here. And then I'm going to back out monthly payment, my full monthly payment. And the reason for that distinction, right, is because interest is considered a cost of doing business. It's considered an operating cost, and I can expense interest, which impacts my tax line, right? My taxes are based on my net operating income. My principal payments are not. So you could back out principal payments and you have your interest, go down and your principal payments go up. as the year progresses. For me, I projected interest just to be, well, seasonal. So I'm also paying some credit card interest in there, I would assume, the way I have it set up. And I just want to back out a set amount. So if I know my monthly payments are $3,000 and my interest fluctuates depending on, you know, the extension of my line of credit or the extension of my credit cards, I can just use this and go across. And if you have depreciation, if you've projected depreciation, you would want to add that back as well, because that's a non-cash transaction, right? So a depreciation is a way to reduce your tax burden. You show an expense, but you don't actually pay anything out. So, you know, it reduces your net operating income. It reduces your taxes as a result, but you don't have to actually pay it. So you would add it back to get to a cash flow. I don't have it, but I'll just put a note in there. If you do have it, you want to add it back. And then I'm going to add one more line. Sorry, I know it's complicated, but I'm going to back out capital expense. In case I want to buy some new equipment, in case I want to, you know, reinvest in something, I want to add a line there so that I can show that. So then I have total cash change. Actually, what I'm going to do, I'll just say ending cash. And my ending cash is going to be my starting cash position minus my taxes, adding my interest minus my monthly payment, adding depreciation, right, because that's non-cash, and backing out my capital. So I started with 25,000. Oh, shoot, sorry. One other thing, most importantly, right? I'm going to add my net operating income, the income from my business, right? So my business made money. So I started with 25,000. Oops. Started with 25,000. My business made almost 4,000. Of that, I had to pay out 3,000. You know, my business paid interest. You know, so that kind of nets out, but it washes back in the monthly payment. So my ending cash is slightly above where it was. Everybody with me so far? Questions on that and the calculation there? Good. Okay. So I'm going to copy my ending cash position across. But here's the catch, right? So my starting cash position for every month is the ending cash position for the prior month. So February 1 at 12:01 a.m., same cash position as January 31, 11:59 p.m., right? So what I end the month with becomes what I start the next month with. And that's important because unlike the income statement, the operating statement, where every single month is a standalone summary of the month's activity, the cash flow shows your ebb and your flow of your cash, your seasonality, month in and month out, right? So my starting cash position for 2022 is 25,000. Remember, it's the whole year for this summary column that I'm talking about. I'm going to pay out $21,000 in taxes. I have $36,000 in monthly payments. And so my ending cash for the year should be the same as my ending cash for December. Again, it's that cumulative amount. So in other words, my summary for the year is that I start with $25,000 in my bank account. I make $73,000. I spend $21,000 in taxes. I spend $36,000 in principal and interest payments. And right now I don't spend anything on any capital expense or depreciation. So I go from 21,000 to 51,000, or 25,000 to 51,000. So it's not as simple as simply saying I started with 25,000 and I made 73,000. Right? We want to take into account these other things. So now we have legitimately a cash flow statement. Right? It's simplified. It doesn't have accounts receivable and accounts payable. It doesn't have inventory if I'm building inventory or running down my inventory. But it gives me at least an understanding of where my cash is and where it's going. Could be good, could be bad. For me, in this situation, which is totally made up, it's good, right? It's moving in the right direction. I'm covering my principal and interest payments, covering my taxes. If I want to, I could add as capital expense or another line item for owner's draw, right? That would be a simple new column, right? Where I say owner's draw. And I'm going to draw down on this. And all you do is you just back out whatever owner's draw you have. Right? Equations exactly the same. And if I look at this and I'm saying, okay, I go from 25 to 51. So for December, I'm going to take a $25,000 owner's draw. Then that leaves me with 26,000 in the bank. Owner's draw is already after taxes. So it doesn't change my tax burden. It's just a matter of what am I paying myself when, and how does that look to my bank balance, my cash flow, right? So, excuse me. Sorry, I keep getting the same error, so let me just fix this really quickly. So now I want to play with this, right? So all we've done so far is historic based. All we're saying is what we've done in the past is what we're going to continue doing, and this is what it looks like if we're moving in this direction. So say I'm looking at this, and it's not good enough. It's not what I want to do. I'm only improving my cash position by 16 or 26,000, and I'm not part of this labor cost, wherever it is, administrative payroll. That's not me. I need to take more than 26,000. My own salary needs, say I need to take 3,000 a month to cover my personal costs, right? So if I put that in here, all of a sudden this cash flow is looking worse. Right? If I need to cover my personal mortgage, groceries, clothing, I need a bare minimum of 36,000 for the year. And that means my cash position is going from 25,000 to 15,000. Okay, that's not good, right? So what changes do we need to make to improve that, to make that reasonable? First thing that comes to mind, right, is increase our revenue. So if I say, okay, to increase my cash flow position, right now, it's 15,423. That's my year-end cash position. I just wrote it down so that we have that as a benchmark. So as we play with this, we can reference, am I doing better or worse than I would be doing otherwise? So if my first thought is my retail sales aren't going up as much as they could be, right? They're going up, but it's mostly in reaction to my blog posts, which I do every other week. What I really need to do is invest in advertising and promotion, actively get out there, push social media ads, send some print mailing, buy some airtime on Sunday Night Football, and really drive my retail sales up. So the first thing I'm going to do, remember when we talked about this originally, there's a cost and there's an intended result. So my cost is advertising and marketing. past couple of years, I just spent about $6,000, $500 a month on a Sun Journal ad and a Facebook ad every single month. I'm going to blow this out of the water. I'm going to spend $30,000 this year on advertising. I'm going to quintuple my investment in advertising. And instead of that same kind of, plodding along increases to my retail sales, I want to see 250,000. Right? I'm going to double my retail sales. I'm going to go from 170, let's call it 300. Why not? True doubling, right? It's still going to be seasonal, but I'm going to really try to drive my retail sales up. Now, keep in mind, right? 170,000 to 300,000, it's a $130,000 increase. I'm not keeping $130,000 more in sales. I have to pay out 56 cents of every dollar I make to cover the costs of what I'm selling, right? I have to cover my costs. My costs are going to be exactly the same as a percent of revenue. So even though I'm driving up my sales from 374 to 519, my gross profit after costs is only going from 166 to 227. On top of that, I'm spending 25,000 more in advertising and promotion. So my bottom line is going from $15,000 in cash to $33,000 in cash. So despite the fact that I'm adding $130,000 to my retail sales, my cash position at year end goes up 18,000. That's not great, right? That's a lot of work and a lot of effort and a lot of new sales to only make 18,000 more. On top of that, well, okay, so I am coming out ahead. My cash position is increasing. So that's a positive move, right? We can also use this to stress test, right? And by stress test, I mean, what's a reasonable expectation and what happens if, right? So this 30,000 of the cost associated with this activity is fixed. If I'm saying this year I'm going to spend $2,500 a month on advertising, I'm going to spend that. What is less predictable is the offsetting revenue. So if my offsetting revenue is 300,000, that's my goal. 19,800, 20,000, 21,000, 24,000, 26,000, 30,000, 32,000 Christmas. I've got that peak. But let's say I get through 3 months and it's only looking like I'm going to hit 250,000. I'm stress testing this now, saying, okay, I'm missing my goal. I'm still improving. Don't get me wrong. It's going in the right direction. Is it enough? No, right? $3,000 increase over other projections is not enough of an increase to me for that level of effort and investment. To look at this and say, I've got to spend 5 times as much time designing my marketing plan, working on my marketing. I've got to, still increase my sales by 75,000, and I get to keep 3,000 more. Jeez, I could have not paid a bonus to my admin and had the same cash effect, right? So there are ways to say, okay, what's my margin of error where this still makes sense? To invest that much, if I get to 275, I only make $720 for the whole year. I'm only $720 richer than I was at the beginning of the year. I paid myself, I paid my taxes, I covered everything else, but that's still a lot of work and a lot of your time for $720. So, that's the way I like to use this model, to just say, what is my effort and what does that actually look like on paper, and does it make sense? You can also use, if I say, I'm going to buy a piece of equipment, I want to buy $10,000 piece of packing equipment. Okay, that's my capital expense. And it's going to reduce my packaging cost by 2%. I'm going to drop this to 1%. And my wages are going to go down as well because I can pack more quickly. So this is going to drop to 30%. What do you know? That is a worthwhile investment, right? Again, it's the cost. I know what that is, and it's my intended outcome. Right? People can package the product much more quickly with this product, and it actually reduces my cost of goods for packaging. Because, I don't know, it does it itself, or creates, use less tape using this machine. Who knows, right? But if you have your intended outcome and the cost, it is extremely simple to see the outcome. To say, okay, I don't, if I spend that in January, my cash position stays strong, low point of about 12,000, 14,000, but I end the year much better off than I was otherwise. And this piece of equipment has a lifespan of 7 years, right? So these changes are going to continue forward. Now let's say I don't get a full, 4% reduction in by direct wages. It's only 2%, drops to 32 instead of 34. Does it still make sense? Well, less so, right? But still moving in the right direction. And if I can use this piece of equipment beyond this year, so much the better, right? And I still come out ahead. It still works. What if it's 33%? Still come out ahead. Cash position's a little tighter, but moving in the right direction, right? So for me, if I'm looking at this and I can say I can save my people, 10, 20% of their time on packaging, and even if it only saves them 5% of their time on packaging, it still makes sense. That's a much better investment of my time and my money than trying to drive up my sales. Is driving up your sales still a good idea? Sure, still makes sense. But controlling your costs, hey, it's a much better way of investing that time or money in both the short term and the long term. And you can do this with whatever decision you have ahead of you as a business owner. Right? If I want to say, I want to add another admin person to my payroll, it's going to make my job easier as an owner. And that's going to be another $25,000. So part-time admin to answer the phones Monday, Tuesday, Wednesday, so that I can focus on operations for that period of time. What do I have to do to my sales to cover that cost, the extra $25,000, right? How much more do I need to be productive on my operations side to offset that? Right? So my original estimate for service, say I'm going to spend that time working in the service department, was $100,000. As we play with this, we can figure out what the offset is to replace that salary, basically cover that salary. I don't want to do it. I want to hire someone to do it. I'm much happier doing the operational side. Okay, if I can drive up sales from 100,000 to 160,000, I cover that person's salary, and I still come out easy, right? It's just the cost, the result you're looking for. Now, can I get that result? Is it achievable? That's up to you to decide. If your operations are, you know your operations. If I'm a business owner and I'm looking at that and I say, geez, I hate the admin side. I really don't like being in the office. I'd much rather be in the shop, working in the shop. And if I'm in the shop 3 more days a week, I can do, $60,000 in additional service sales. No problem. Great. Go do it. And then give yourself, okay, that covers the cost, but can I do 225? Can I more than double service by being in there more often? Well, hey, your business is better off with you there. and not in the office. That administrative overhead, it's non-productive. If you're not being productive where you're best situated, it's easier to pay someone else to do that and you go be productive, right? For a lot of operational owners, that's why they decided to do it themselves. They can do it faster, they can do it cheaper, they could do it at a better quality than paying someone else to do it. So for most business owners I talk to, you'd rather be in the shop, right? You'd rather be on the floor. You'd rather be doing what you do best. So at what point is your productivity best spent providing service, creating revenue, than it is in the administrative side? And understanding the cost and effectiveness of hiring someone to do the admin for you rather than wearing both hats. Again, very straightforward. What is the cost? What can you be doing otherwise that would generate revenue? Does it generate enough revenue to offset the cost of it? So I'm going to get off that soapbox. We've spent enough time talking about this model and how to use it. At this point, you should be pretty easily to manipulate this, make those changes, and at least see the path forward. Again, one of the things we talked about at the very beginning, this is not the end of your business, right? This is the beginning of the business. This is the floor of the business. By no means do I want to present this as the only way to run the business. But if you're making a decision without understanding the cash implications of your decision, that's a slippery slope. It can work for you for a long time, but when it stops working, it's better to know about it in advance rather than when that first check bounces. So, effective use of this model. Great thing about QuickBooks, right at the top, there's a tools, both in the desktop version of this as well as online. There's a tools tab. There's a budgeting tab under that. You can literally take this information and in 5 or 10 minutes, you can plug into your own chart of accounts, your revenue projections, and your expense projections month by month for the coming year. It's a little manual. You've got to plug it in, but if you have it, we've built it out, you've got it, put it into QuickBooks, because QuickBooks has these two reports, right? You've got your budget versus actuals, which you can run every month, and it shows you and it lays it out for you your budget performance, what you've put together, what we've established over the last couple of weeks, your actual performance, whatever you actually did for that period of time, and the difference. It shows you very clearly how close were you? Were you good? Were you bad? How far off percentage-wise and numerically, dollar for dollar. Takes 5 minutes to run the report, go through it and say, okay, I was in line, plus or minus, don't care about it. Where did I miss? What was I way off in and why? Right? And as an owner, you're in the trenches, right? You're running your business, you're on the floor. Take a step back, 5 or 10 minutes out of the, out of your schedule a month, and just say, hey, do I understand my business? Is it in line with what I expect? Is my cost of goods as a percent of my revenue in line with where it's been, in line with what I intended to do? Are the decisions I made panning out the way I thought they were going to? And if the answer is yes, then forget about it and get back to doing what you're doing. But if the answer is no, find out about it, right? Figure out where that hole in the boat is before it becomes a problem, before you take on too much water. It's not a huge burden for you to run that report and double check. You can also do the same report, profit and loss comparison, which I've also highlighted here, against prior year. And it's the same concept, right? You're saying, okay, January 2022 compared to January 2021. Am I doing better this year than I did last year? Am I doing better this year than I expected to do? If you can say yes to both of those, that's amazing, right? You're doing what you want to do. You're improving your business. If the answer is no, why not? And how can you change it? So I think that's all I've got today. So I've got, a couple more minutes for questions, some simple kind of parting thoughts that I want to leave you with. Be conservative in your estimates, even if it's just for yourself. it's always nice to be pleasantly surprised. So as you're putting these projections together, give yourself some opportunities to pat yourself on the back at the end of the month. It's nice to have that. You don't get that a lot. You don't get positive feedback as an owner. It's a lot of criticism, a lot of people second guessing your decisions. So, give yourself a little bit of a chance there to succeed and lead yourself in the right direction. It's worthwhile to use this. This is the most confused you'll ever be. This is not information that comes easily to operational owners, which I know most of you are. Use it. The more you use it, the easier it is to understand it, the easier it is to communicate this to other professionals, accountants, attorneys, business brokers, whatever, commercial lenders. So the utilization of this does make it easier. It does come more easily. Use a separate bank account, right? A lot of you do. I'd reiterate the importance of that, both from a legal perspective. It makes it easier if you're in a court of law defending that you have an LLC separate from your personal, that it's a separate bank account, right? So that separation helps if that situation arises. And it's easier to track, right? It's much easier to go through your chart of accounts or your monthly reconciliation and say, okay, my cash position should be $26,500 and my bank account is $26,498. Okay, good enough, right? Don't tell your bookkeeper I said that, but it's don't waste a lot of time trying to get it exact. Your time is better spent on the floor, right? Making the operations, doing what you do best. If you're a couple dollars off, pay someone else to go hunt that down, make sure it's reconciled. And do reconcile every month, right? But don't try it yourself. It's tedious. It's not worthwhile. And again, your time's better spent elsewhere. So maximize that. And learn industrial benchmarks, right? This kind of goes back to that idea of, are you doing better than you did last year? Are you doing better than your budgeted performance? Those industrial benchmarks are a great way to just double check and say, are they in line with similar businesses in my industry? Where is my competitive advantage? Where can I do better? So those industrial benchmarks, industry benchmarks, can be beneficial for you. Again, my email, I invite you to reach out. I will be reaching out at first week of January, first week of February to check in and see how you did. So look for that email from me. I'd love to hear about your business otherwise, especially if there's something I can do to help. But yeah, so I think that's it for today. I'll stay on for another minute or two, see if there's any questions in the chat, or if you want to just take yourself off of mute. But really appreciate the time you've taken with me over the last couple of weeks, and I hope it generated at least a reasonable financial model for you to work towards for the next year.